Hello everyone, my name is Arjun.Madnani and let me give a background about myself. I am a CFA Level 3 candidate and I have done my PGDM in Real Estate from NMIMS and my Bachelor's in Business Administration from the same university. So one of my friends has a startup in finance and they requested me that they wanted a holistic overview of the economic scenarios that would come up in the coronavirus state. So, since I have the data, I thought it's better if I share it out there and it can reach as many of you as possible. So, here it goes. As we know, the coronavirus has caused a complete stop in our daily lives. It has caused an economic cessation of activities, and this has impacted all of us and how. So, the issue out here is that everyone is getting anxious because of that, and we are going online and searching for data. And when we search for data, we find data on health, on economics, as well as on conspiracy theories about how this originated. There is no one particular source which gives out the accurate information on how should we go about things. So I combined the various sources. I went through various texts of companies and took out data from all of them. And so basically there is data and there is noise. I've tried my best to filter out all the noise as much as I could and present you the data. In case you feel that something has been missed or something should have been added, please add it in the comments. These are the topics we're going to cover. So, firstly, as we know about coronavirus, it is a very infectious disease. It's caused by the novel coronavirus. Usually, there are mild symptoms. Some cases are very fatal. It is high risk for the older generation and for people with existing health conditions. There's higher mortality in males than in females. In fact, the mortality in males is twice as that in females in each and every age group. There are a handful of cases of possible reinfection. However, it's not really reinfection. They just feel like the virus is recurring in those people. So basically, it's resurfacing, kind of that. There are safeguard mechanisms, and the only safeguard mechanism right now we have is social distancing, since there's no vaccine available as on date on this issue. Now, as on 3rd April, the cases worldwide were a little above 1 million, and we had around 53,000 deaths. The point out here is yeah. The point out here is this data we'll get it online. However, what is of economic importance out here is this. Wherever you go, you will see that everywhere all the websites are mentioning deaths divided by the total number of cases. However, I certainly feel that this is a misguided statistic. You should always look at your deaths divided by the closed cases. That is because these active cases right now, we have no clue how these are going to end. So you always look at the deaths divided by the closed number of cases, and that is going to go up to 20%, which is a very high number. In India per se, as on 3rd April, there were around 2,500 cases and 72 deaths. The same way, if you look at India, the deaths divided by entire number of cases is as high as 28%. And even though it's just 2,500 cases, if you look at these three graphs out here, the problematic issue is towards the end, you can see that the graph is growing very steep. And this is the issue. The rate of increase is very high. And as of now, of what the news reported, the government has still not gone for door-to-door testing of people. These are still the people who felt unwell and then came ahead to the government, got themselves tested, and turned out to be positive. There are still many people out there in the incubation period, and we have no clue how many they are. Now, on the economic scenario, the IMF slashed the current world GDP growth forecast to 1.6% in 2020. In 2019, it was estimated up to 2.9%, and the coronavirus outbreak can cause the global economy up to $2 trillion. This is even more than the GDP of China. The India growth GDP growth forecast has been slashed by each and every major rating agency. In fact, if you look at the Economic Intelligence Unit, it has slashed it the most. The world GDP growth forecast for 2020, for JP Morgan, they actually expect the entire world GDP to contract instead of expanding even by 0.3%, which is reported by Morgan Stanley. Now, whenever you look at the impacts of a certain scenario, you should always look at what was the economic scenario before it happened and then look at the scenario after it happened. So before it happened, the activity was low. There was improvement in manufacturing and services though. The global GDP growth rate was falling down in Q4 2019 to around just 2.5%. The industrial productions were stagnating. There was lower growth in consumer spending all around the world, and the merchandise trade volumes were falling in Q4. And the investment growth in the G20 countries, excluding China, in 2018 it was close to 5%. In 2019, it went to just 1%. If you look at this graph out here, you will see that in the Q4 of 2019, the global GDP growth fell by a huge margin. Now, looking at the country-wise scenarios, in Japan, the demand fell sharply following the consumption tax increase in October 2019. In India, there were large non-performing loans and over-leveraged balance sheets which weighed down on these investments. In USA, the growth more or less remained close to the trend forecast. In China, the GDP growth was slowly easing out. What happened was the US-China trade tensions. So as we know, higher tariffs were imposed over 2 years between bilateral trade relations by both of these countries. And this was majorly contributing to the economic slowdown we are experiencing. Since China, we know, is a production hub and USA is one of the major consumption-based economies out there. So finally, they settled their disputes and the Phase 1 trade agreement was signed in January 2020, which was supposed to reduce the drag on global GDP growth by 0.1%. So if you have a look at this graph out here, the red dots represent before Phase 1 deal, what was the scenario, and the green dots represent after Phase 1 deal. So the difference from baseline in 2021, 22 had actually reduced. So the world GDP, USA GDP, China GDP, and the world trade actually benefited from the Trade 1 agreement. Now, the entire issue out here is they did not factor in the coronavirus scenario at that point of time. So we have no clue what is going to happen and if this deal still stands true and if China will actually be able to buy the goods it committed to buy under this deal. Now, post the COVID-19 outbreak, we have three main variables we'll look at: the economic variables, the types of economies, and the country-wise scenarios. Having a look at the economic variables, there were four basic economic variables which have been impacted. Firstly, as we all know, there is a fall in demand. That is because there are no consumers to purchase these goods and services. There are major restrictions on travel and tourism, and also on manufacturing and your retail sector. The only thing which we see functioning right now are the kirana stores and the essential commodities. So this has led to a widespread fall in demand for these goods by the local public. Now, this fall in demand is hitting these businesses and this is leading to unemployment. This unemployment will lead to, of course, lesser disposable income in the hands of the people. And they will do only one thing at such point of time. They will cut down on their discretionary expenses. And when they cut down on their discretionary expenses, it is the retail segment which is going to be hit the most out here. So you're going to see a cascading effect on the retail industry. Then we have a look at the debt markets. The debt markets have been plagued by slow growth of high corporate debt and deteriorating credit quality. So if you look at the bonds issued overall in 2019, more than 50% of the investment grade bonds issued were of the BBB grade and around 25% were below investment grade, which are the risky bonds. Now, there is a high probability that in the current scenario, the BBB rated bonds are actually going to fall down and go below investment grade. So that is going to be a huge hit to the bond economy. Now, having a look at the FDI impact. The downward impact of COVID-19 on FDI is expected to be around minus 30% to minus 40%. There are 61% of multinational enterprises who have issued revised statements in March 2020, and 57% of them have raised concerns on how the sales are going to happen during this period of crisis. There are downward revision in earnings estimates of up to 30% by top 5,000 MNEs. So all of these top 5,000 MNEs, they are expecting their earlier sales forecast to be invalid in this scenario, and hence they are revising their earnings. The problem is the market factored in their sales forecasts, and the market had expected that the revenues are going to be higher, so the profits and earnings are going to be higher, so the valuation is going to be higher. Which is why right now you're seeing the stock markets in major economies and almost all of the stock markets crashing down. There's a potential 50 to 70% decline in cross-border M&A and reinvestments. So in FDI, the major aspect has been reinvestments. So basically, if there's a foreign company and it invests in a domestic company, when a domestic company gives out its revenues and it sends them back to the foreign entity will reinvest it back in the country in the form of FDI. And this is like a yearly guarantee kind of thing where a certain amount of money will come in. So whatever you repatriate, they will invest it back because of course they get higher returns in our country. So the problem is in such a scenario, these reinvestments are not going to happen because they are actually pulling out the money existing in the market as of now. So that has caused a major FDI impact. Now, having a look at the types of economies and how they are impacted. Firstly, the developed economies. The developed economies have speculative financial positions. So they have an unsustainable level of debt and highly leveraged corporate loans. And so basically, after the 2008 global financial crisis, the governments told the banks to go out and give money to the people, to the businesses at easier rates, not subprime mortgages. That was the cause, but basically at easier rates and at better terms to the people. So there was basically cheap credit in the markets, and these companies took the credit and some of the amounts they invested in the developing economies so as to earn higher rates of interest and to earn the differential profit. Now, this cheap credit spill over to the developing economies, and because of that, the debt sustainability of the developing economies was actually overestimated. So they undermined the debt sustainability. There was easy money. So basically, investments in high tech emerging economies were done by these companies because high tech emerging economies give them more returns. So they took money from the banks and they invested in these assets. So in the current crisis, the governments of these economies rolled out stimulus packages. However, these packages are expected to be highly ineffective. The point out here is it is going to give a boost of $1.4 trillion for developed economies, including China. However, the headline value of these packages is much more than that amount. So the steps taken by these economies cannot really save them from a recession this year. However, it might save them from a depression in the coming years. And basically, that's because it having such packages puts a stop to the fall in prices of commodities and of financial assets because the people have certain liquidity, and when the government gives out money to their business and everything, people get a reinforced belief that these businesses can survive and they are safe enough. Now, having a look at developing countries, firstly, they have international reserve currencies. However, the problem is developing countries do not issue these currencies. They have only two ways of getting them, either through exports or through sale of their very own reserves. The point with exports is exports are going to be hammered down in such a scenario because the developed countries and other countries will not really want to put their money in imports of non-essential commodities in such a scenario. Plus, for exports to happen, the developing countries have to significantly import equipment and financial knowledge. So they actually need to spend money more rather than exporting it. So we can also see that the rupee is trading at a record low compared to the dollar. There are sharp currency devaluations. And because of that, it is going to be very difficult for these countries to service their debt and pay for their foreign commodity imports. So if you have a look at the net portfolio flows between 21st Feb to 24th March 2020, so around a month's time, the net portfolio flows have been close to negative 59 billion in these developing countries. Especially if you have a look at this graph out here, the first bar is after the GFC in 2008, and the second bar is after COVID-19 crisis. So after GFC, the net portfolio flows were close to negative $26 billion. After this crisis, it has increased to close to minus $59 billion. So you can see it has more than doubled in value about compared to what was the amounts that were withdrawn earlier. Now, having a look at the bond spreads. So bond spreads are primarily they give out the riskiness in any investment. So uh, when you are investing in cross-country bonds, you are going to look at the differential risk associated with it, which are given by bond spreads. So these have been seen rising sharply, showing that there's an additional risk premium that is being priced into these bonds. The investors feel that these bonds are riskier compared to the bonds of their own country, and hence they want a higher rate of return so as to let that part with their money. So if you see this graph, the effective yield after the main shock, this graph has shows that in the orange line, after the COVID-19 crisis, the effective yield has closely increased in compared to post GFC. However, you should always look at the option adjusted spread rather than the normal spread. So in this graph, you can see at a certain time period, it has even gone above the global financial crisis. So what we are looking at is a very grim scenario for the developing countries right now. Now, looking at the currency value, the currencies of these developing countries, as I mentioned earlier, have depreciated sharply against the dollar, which is showing an additional risk premium, which is greater than that after the global financial crisis. So, in this graph out here, the orange bars represent your global financial crisis, and the blue bars represent the coronavirus crisis. So you can see the depreciation in each and every developing country has been much more than what it was after the GFC. And now having a look at the commodity prices, Brent crude has fallen 63% from January 2020 till date. It is unfair to attribute this to coronavirus because the main cause of this were the OPEC and Russia issues. However, if we consider that and if we still add the other commodities, then still the overall decline in prices has been 37%. So the coronavirus has impacted overall commodity prices. The major declines are seen, of course, in oil, but again, because of both the reasons. However, other than that, in metals and in mineral products. Okay, so there are five basic pointers which we see in the developing countries right now while analyzing the data, which I showed to you before. During 2008 GFC, there were massive stimulus packages which were announced. However, it took 5 consecutive quarters for the economy to recover. The recession this year is difficult to be averted, and we can certainly say that it might even get extended. The conditions during 2009 were favorable because the developing countries had more growth rates, probably, and the demand for exports and the appetite for risky assets was higher at that time. Currently, we are basically plagued with weak interstate capacity, and because of all the financial market and the turmoil out there, there is a diminishing fiscal space and a rise in illicit financial flows. Because of the damage which has happened to the global supply chains out here, the firms all around are really going to rethink their strategy. Everyone is going to remember how their business shut down at this point of time, and the lead firms will not want this crisis to repeat. So basically, what they will do, they will try to shift their suppliers closer to home. They will try to go domestic with their suppliers so that at least their products are manufactured better, and they might even go domestic with their sales because the logistics around the world for exports are affected. There is a rapid buildup of private debt in the reserve currencies. So the companies are going for private debt in dollars and deals in dollars because it is cheaper that way, and even the currency risk can be hedged at certain points of time. And because of that, the ownership of the debt of in reserve currencies is shifting from the government to the private creditors. And because of that, there's a highly fragile debt market right now, and there's high instability of exchange rates. There's a continuously weakening ability to build up your international reserves as a buffer against macroeconomic shocks. So what happened after the 2009 crisis was that developing nations really piled up on reserves, and because they did not want their impact to repeat. However, the problem is that since these commodities, these reserves are in the form of commodities and in the form of reserve currencies, and commodity prices and reserve and the currency rates have been fluctuating a lot. So maintaining that percentage of reserves right now for the developing countries is highly impossible because of the continuously fluctuating prices. Now, having a look at the transmission mechanism, this tells us basically how is the crisis going to happen in the developing nations. Firstly, government budgets. As we have seen in the news, our government is trying to spend a huge amount of money so as to give the essentials to the people. Taking the economy back on track is completely another ball game right now. So because of that, the pressure due to a social health crisis has increased a lot on the government. And in social distancing and falls and and lockdowns, there's a fall in income levels which has happened out here. And because of that, the government has been spending a huge amount of money, firstly in maintaining the social distancing practice, and also secondly ensuring that the poor and the needy people have the money for the essentials. Having a look at international trade, there's overall a lower demand of exports, and the demand for exports of the developing nations can fall ahead. You can expect exports of the developing nations to contract by $800 billion. And of course, even the imports will contract, but only by $575 billion. So the differential, that is what is going to cause a problem for these developing nations, because already they were importing more than they were exporting in terms of the different commodities depending upon different countries. So the current account deficit of these countries is expected to increase further, and the financial payments are going to be more difficult because of the currency depreciation. Having a look at the financials now, there are record capital outflows from all of these economies. Like we have been hearing in the news every day that foreign investors have been pulling their money out of Indian markets. So because of that, there's a very high pressure on the debt which has already been taken by our country. In fact, the entire debt combined of the developing nations is 198% of their combined GDP. So making these payments back is going to be a huge issue for these nations. And secondly, rollover of these outstanding debts is very improbable because in such a situation, every country will want to maintain liquidity. So people are probably not going to allow developing nations to just roll over these debts. Looking at the revised GDP growth forecasts for India, the previous forecast was 6%, went down to 2.1%. Now the country-wise crisis, which we are looking at. In USA, every single day we are seeing the numbers increase. So the social distancing which the government has been trying has led to large-scale stoppage of economic activities like in India. There's a very sharp decline in the consumer discretionary spending. We are looking at the Q1 and Q2 GDP of USA to contract, and the because of the spending fall. The third quarter GDP can go up because there can be a rise in consumer spending. However, it is completely dependent upon when the virus spread stops and when the economic activities can start again. Now, having a look at China, China is an epicenter of this virus. So it was the first to adopt social distancing practices. Now, China is a production hub, and they have been exporters of commodities mainly. It's a supplier to the world. So, a social distancing norm in China has hit the world production, and all the economies are experiencing supply shortages because of that. Secondly, In the travel industry, Chinese account for 10% of the entire world travelers. The tourism will take a major hit in these economies because of that. For Europe, Germany, and UK, the economy is expected to fall by 5% this year. And the UK economy is also expected to contract by 5.1% in 2020. Having a look at our country now, India may really not slip into a recession this year. And there are multiple reasons for it, and that I will probably cover in another video. However, it will still experience significant GDP impact. The impact of the current lockdown is expected to spill over to first quarter of 2021 because that is the amount of time we will take to come out of this lockdown and get our production facilities back on track. The Indian GDP growth was already at a very low level before this crisis happened. So this crisis is going to impact the poor population more, and they will see further wage cuts. Now we look at the major rating agencies. All of them have slashed their GDP growths for India, and especially Moody's, it only expects the 2021 GDP growth rate of 2.5% for India. The second issue which they had was for the financial sector. They are expecting severe liquidity constraints and they expect the asset and the credit qualities to really fall. And that is, according to them, that is going to plague the financial sector a lot. Now, since we are always talking about this financial crisis compared to the last one, let us have a comparison on what exactly happened in those two. In 2008, there was no physical reason for the crisis. So it was not that you had to shut everything and sit. The problem was people were not spending and there was a credit crunch in the entire economy. So the government had two major jobs out here, giving money to the businesses and giving money to the people and ensuring that they both spend. So the money multiplier effect takes place in the economy and you will see the economy come back on track. The solution was bridge the output gap. The problem which happened was the output gap was underestimated by the governments. And because of that, the as we saw earlier, the crisis went on for 5 quarters. In 2020, it is completely different right now. It is not that we don't want to spend, it is that we are not allowed to spend because there's a virus out there, and if we go out, we are risking our health. For the same reason, businesses are not willing to sell goods right now because they feel that for that going into production and everything, they'll be risking themselves, risking their workers, risking their entire future scenario. So putting money in the hands of the public for spending is not going to be the solution. However, the issue with the developing nations is the per capita income is very low. So the government needs to give money to the lower section of the population, and that's only for fulfilling their basic essential needs to survive. So the entire killer which out here is the waiting period about how long will it take for the virus to settle, and once it settles, how many businesses are going to be able to survive and how many of them are going to shut shop, because that is what is really going to impact what is going to happen in the economy further. So in the current financial crisis, there are going to be 4 waves which are going to hit. The first wave has already hit us. It is a sudden stop of all activities because of which we can't even step out of our houses right now. Second wave is going to be the economic stop. So by economic stop, what I mean is the GDP is going to fall down and the workers are going to lose their jobs, because if the GDP falls down means the businesses are earning far lesser than they would, and they will first go into cutting their fixed costs. The third is the retirement age. So what happens out here is the people who are nearing retirement age in India, so you can say anywhere with 50 and above, who have planned for having a certain sum of money for their retirement, they plan it through investment in various asset classes, and they have seen all the asset class prices fall right now. So they have seen the entire hard-earned money being completely wiped out in the economy. So they are not going to go out and do their discretionary spending. They are not going to take risks right now because they do not have a source of income for a long period of time. So even after the virus settles down and the crisis is down, these people are not going to go out and spend or to buy that new car or go for that farmhouse. They are going to keep the money so as to ensure that they survive properly. They are able to maintain their current standard of living and not really go on and increase their standard of living ahead. So this economy, if you really want to compare it to something, you can compare it to the post Second World War economy. It's a bit harsh, but that is how it's happening right now. During that economy, the government was focusing on two things: having money for defense and giving money to the people to go out and buy their essentials. That is exactly what is happening right now. Except for defense, it is social distancing. So the money of the government is going to ensure that there is enough social distancing practices so as to save the lives of the public. And the other part of the money is going on to the lower population so as to ensure that they are able to fill their stomachs. So the only solution for the government right now are two things. Firstly, keep money in the hands of the public so that they are able to survive through this period. Secondly, ensure that the demand and the supply stimulus are on point. And you put in small shocks in the economy so that the economy is ready to go up once the virus settles. So when the spread of the virus stops, the governments should be able to provide the stimulus they need so that the economy can come back to track. Looking at the economic impact scenarios, there are two basic variables which we have to consider. Firstly is the spread of the virus and what is the public health side response of the government. And secondly will be the economic response of the government. Again, in spread of the virus and public health response, there are three main scenarios. The response is rapid and effective and the virus is stopped. The response is rapid, but the virus tends to recur. And if there's a broad failure of the public health interventions. On the economic policy response, there are three basic scenarios. If the interventions are effective, if they are partially effective, or if they are highly ineffective. Firstly, we look at if the response is rapid out here and if the economic policy is effective. What happens in this scenario is as soon as the virus spread stops, the growth rates will pull up and the economy will experience a V-shaped growth. This is the best case scenario for all of us. Second is if the public health response is effective, but the government response is partially effective because of various factors. So we will see the growth rates a little later than what we will see in this scenario. Thirdly, if the public health response is effective, but the economic response is highly ineffective, in that the growth rates are going to be seen much later, and we can expect around 3 to 4 quarters of economic slowdown. The fourth case will be an effective response, but if the virus recurs, which is a high probability at this stage, but if the government interventions are effective, so out here the growth rate will go back up, but every time the virus recurs, you are going to see a fall in the growth rates. And because of that, you can see that there might be some downturns on whenever the slowdown or if there is a probable small lockdown in the future that happens. But overall, it will be an upward sloping trend. Secondly, in such a scenario, if the government response is partially effective in the economic front, the growth rates can be seen later. And if it's highly ineffective, we will see it stretch for a longer period of time. Thirdly, if there's a broad failure of the public health interventions, this is one of the worst scenarios for all of us from a human aspect. But if the economic effectives, if economic scenario of the country improves, and if those interventions are effective, then during this period out here, we are going to see a rapid fall in everything, probably. It is basically going to be a complete loss of human lives. However, once that stops, then we can see the economy going back up. if there is a broad failure of the public health interventions and if the economic interventions are partially effective, then in that case, the pandemic situation is going to be bad. However, the government is going to try to pull it up how much they are able to, and the economic growth per se is going to stretch longer. And the last and the worst case scenario is if the public health interventions fail and the economic interventions fail, because we are not really sure of what we are dealing with right now, and we do not know what's going to happen ahead. There is going to be a prolonged downturn in the entire economy aspect. However, I don't think in such a scenario, economy will be a real big concern for the government or for any of us. Our main concern in such a scenario will be saving lives. However, if you look at it from an economic standpoint, then you can expect growth rates all around the world to fall. Looking at the sector-wise impacts first, the high-risk sectors, which will have the nearest term impact, are two main sectors. Firstly is the airline services and secondly is the premium hotels. Both of these are because travel has been hit hard and discretionary spending is not going to happen by the consumers. In the longer term impact, we are going to see construction impacted because people are not going to go back with their laborers for carrying on construction activities, as well as your banks may not really be keen to invest more money into construction when there's an economic stop of activity. The second is going to be gems and jewelry. That's because luxury takes a hit first whenever such a crisis strikes, and the discretionary spending of the population is going to come down. Third is the textiles, basically the cotton yarn industry. And the textiles and ready-made garments, because garments are not something which anyone will want in such a scenario, especially when you compare it to essentials like food. So, and also the exports of garments from the developing nations are going to fall overall. So, textiles of cotton yarn and of ready-made garments are going to take a hit. Looking at the moderate impact scenario, automobiles and auto components, again because of fall in discretionary spending, especially when the automobile sector has already been hit by the BS6 emission norms. Petrochemicals, they say that the receivables can be hit due to large exposure to the Chinese economy, and small and mid-sized firms mainly need to have a focus on their liquidity more than looking at profits. IT services, and that's mainly because travel is going to be hit. So deal closure in the IT industry can see an extended period of time, and that can lead to a liquidity crisis when you look at small and medium enterprises and the various IT startups which have come up right now. However, the depreciation of our currency, which is bad for most of us, is going to be beneficial for the IT sector because they are net exporters. Looking at renewables now, if there are under construction projects which were scheduled for May or June 2020, these are going to risk delays. The operating projects will not have much impact. That's because they are already operating. Then there's consumer durables. China is the main supplier. It is currently a supplier of 45% of the completely built up units and 70% of the smartphone components. So because of the China lockdown, the supply of these items has taken a hit and the prices have gone up anywhere near 3 to 7%. If China starts production again, and I found an article which said that it has started, and if the supply disruptions are addressed well, then we can see this sector not have much an impact. However, probably that's not going to be a scenario. Looking at the small impact sectors now, firstly is pharmaceuticals. As we all know, medicines are in demand right now. However, the problem is 68% of the pharmaceutical supply comes from China for the raw materials. Now, luckily, due to the Chinese Lunar New Year, they already had a stock of raw materials of around 2 to 3 months. So these companies are able to carry out production as of now. However, if the supply disruption of raw materials is not addressed properly, we are going to be hit by a shortage of medicines. and the government is not really going to let these companies increase the final prices of their products because medicines are essential and the government is really going to monitor on those prices. So these companies are going to be hit by a ceiling in prices and an increase in the raw material costs, and that is going to squeeze out their margins. Then there's power other than renewables. This is mainly a domestic based industry, and according to the data available, it will not have a much impact. However, the overall economic impact of credit crunch and all of those aspects will hit this industry. Impact on the financial sector overall. In an article on 2nd April 2020, the Moody's Investment Services downgraded the Indian banking system overall from a stable to a negative outlook. These were the following reasons cited for that. Firstly, there are severe liquidity constraints which have plagued our sector, and that has become a major hindrance to our growth. This is and In such a crisis, since the asset prices are following, we will see a deterioration of overall asset quality. There will be a sharp decline in your economic activity and a rise in unemployment because of that. And since the businesses will earn lesser, paying the money and the interest back to the banks is going to be very difficult for them. And we have also seen growing problems in the NBFI sector with the Yes Bank crisis. And the entire problem out here is, yes, the government has taken good initiatives for it and it has stepped up the public sector banking units. However, people are really unsure out here that what exactly is the capacity of the public sector banks and how many problems are they going to be able to absorb in their balance sheets, and what is the true scenario as on case. Nobody knows it. So there are growing problems in these sectors. And there is overall private investment which has taken a hit. And with private investors pulling out their money, the payables left for the financial sector has been lesser overall. Looking at the extended crisis impact right now, the red areas show the problems in the industries if the crisis extends beyond the normal period. So you can see your automobile sector taking a hit overall, your airlines, hotels, exports of cotton, yarn, basically textiles, gems and jewelry, IT services, leather, pesticides, steel, and all the allied raw materials which go into these final sectors. The capital market impact right now. Okay, so again, I will tell you one thing. These are not my views. This is not my opinion, and this is not me telling you to change your portfolio anyhow. Okay, let me be very clear on that. This is just the data which I found out from websites and which I have pulled up, and I'm showing it to you right now. Firstly is the crude oil war. Fall in the crude oil prices is a blessing for India in disguise, and that is mainly because we are importers of crude oil. So it is going to reduce our import bill. However, with the companies already dealing in crude oil as a raw material source, a hit on crude oil is going to hit them if their contracts are dated to the previous uh, rates. Having a look at gold now, gold is known as a safe haven asset in cases of uncertainty. So a gold exposure is expected to bring down your portfolio volatility because of an increased diversification. And your experts have said that you should have around 5 to 10% allocation in gold. However, the problem is in the current gold prices, the risk premium has already been factored in. So if you buy gold right now, you are going to pay for the additional risk premium which currently the investors feel. Looking at short-term debt funds now, government bonds are known as a safe haven asset. Problem is the government announced a rate cut recently, and this has already been factored in the long-term government bonds. So investing in long-term government bonds right now might not be that valuable for you. However, it's better to go for short-term debt funds like 2 to 3 year bonds right now. Having a look at the pharma sector is an attractive investment opportunity right now. Yes, it has its risks. However, investing in that can get you better returns. Looking at the aviation and your FMCG sector, definite fall is expected in aviation. And I was surprised, however, they had mentioned that the FMCG sector is plagued by overvaluations right now. So even if your stocks bounce back, them bouncing back to the earlier levels for the FMCG sector, according to them, is not probable. The BFSI sector, as I explained in the previous slide, is plagued with issues right now. It is advisable to reduce the allocation overall to the BFSI sector. However, I would personally say that take your own decisions, take your own calls, sit with your portfolio manager and decide for yourself, because every portfolio has its own objectives and constraints, and that is what determines your need. However, if you want an overall overview of what was there, then this is that. Now, mainly, ensuring your business continuity in a period of such a crisis. For current state, tackle your everyday problems, take one day at a time. In the near term, prepare for a rebound in the economy so you can seek your advantage in this scenario. And in the medium term, plan for the new reality which is going to be there after this crisis. Conduct a stress test for your business. Look at your workforce, identify what the main workers are and who are those workers you cannot work without. It is not morally right, however, it is essential if you're looking at a business survival. Look at your supply chain, identify the various operating issues in your supply chain, where all can you have a hindrance, and what are the aspects which you need to focus on. Look at your communication strategy, identify your key customers and supplier touchpoints, and if those touchpoints are disrupted, then how are you going to focus on that and how are you going to manage that? Go for data-driven analysis. If you think in such a way कि ऐसा हुआ तो ऐसा करूंगा, ऐसा हुआ तो ऐसा करूंगा. So basically, if you're going for a very subjective analysis, then it is not going to benefit your business much. Go for an objective based analysis. Look at data of what happened previously, what happened now. Like I mentioned, if you feel that the global financial crisis outlook is not probable for your business right now, look at the post World War II outlook. Look at what is expected to happen to your industry. Look at the data and formulate your own inputs and use that in your data model to get an output and how you will combat those. Please do not go for subjective analysis at this point of time. Look at your revenue analysis, reevaluate your competitive advantage and your sustainability in your current scenario. Basically, all businesses are, especially as MSMEs, are relied on their top line a lot, and your top line might not really be sustainable at this moment. Lastly, have a look at your head office functions. So you identify the redundant functions and what are not needed for your business continuity per se, and look at the functions which are needed for your business continuity and focus on those more. Now, in the current lockdown, what do business owners need to do and what do they need to brainstorm on? Point number one is your supply chain risk. If your supply chain gets disrupted, then how are you going to carry on with your businesses? What are your key suppliers? Second is a business financial viability. Is your business really financially viable in such a scenario? And if it is not, then how are you going to combat that? Third is your cash to conversion cycle. So, in such a scenario, having a long cash to conversion cycle is not going to benefit you. You have to focus more on your liquidity rather than focusing on your profits. Look at your variable costs. So, in such a scenario, having higher variable costs is better than having higher fixed costs, because if you sell, then you will have those costs in variable costs. Fixed costs are what is going to lead you to shut down your business. So it's better if you try to convert your fixed into variable costs by going for contracts. Revisit your capital investment plans. So, whatever investment plans you had before this crisis, they might not really be uh, probable at this stage, and they might not be sensible considering your liquidity constraints. So, revisit them, have a look at them, and see if those are not what you want right now. Look at your inventory management and how are you going to manage your finished goods inventory as well as your supply chain inventory. Extend your payables and expedite your receivables. These two sound too good to be true, to be frank. Uh, if you extend your payables, you're going to hit your suppliers and lose out on suppliers. And if you extend your payables, your customers will also be wanting to extend their payables. So basically, expediting your receivables will be difficult. Best thing for you will be able to find a middle ground in these two and look into that you can have a proper cash flow cycle so that if your money comes from your customers, it goes to your suppliers then, and it does not really happen that your money is going to your suppliers, however, your customers are not really paying you. In that case, your business is bound to shut down. Look at your alternative supply chain financing options. You can go for discounting your bills receivable and all of those rather than working capital loans if credit quality is a problem for you. And you can basically give customer discounts also so as to pull money early. However, according to me, customer discounts are a relatively expensive source of finance because firstly, you have not factored that cost while calculating your product cost. And secondly, it's never a one-time thing. Your customers are going to want a discount every time when they pay you. And thirdly, if you look at it from a per annum percentage perspective, then you will find that the rates are far higher than the rate of interests of corresponding financing options. Look at non-traditional revenue streams. So if your top line is going to take a hit and if your business income is going to be bad right now, do not focus much on that. The assets you currently have are costing you money, even maintaining them right now. So try to generate revenue from your assets rather than focusing only on your business revenues if your business revenues are not working. Generating revenue from your assets can actually help you keep the liquidity to pay off your daily expenditures, and your business revenue can contribute as a reinvestment for your business again and again so that your business can grow in one stage and your uh, business expenditures per se can be taken care by your asset revenues. However, you will need to find a balance between those two. Okay. Thank you guys. If you want to contact me anyhow, and if you have any queries or if you want the supporting documents and references, I have shared my email ID out here, and you might probably have a different analysis of it compared to what I have seen all the documents. However, that's a very subjective per se, and I was given this opportunity by the financial analyst. Those guys are focusing on the finance industry, and their main aim is to get financial knowledge out to the public. So they have groups where they give out financial news about what is happening in the economy right now, and they also have various educational courses and where they will teach you topics about finance and about stock market so that you can be informed, you can be on the run, and probably they will even train you if you want to deal in stock markets. These are the references. Okay, so I have this thing whereby I love quotes because I feel quotes are what provide you hope every single day to go out and combat a new challenge in your life. In fact, I have a daily quote which comes to me every day on my phone, and that is the first thing I see in the morning. So during this crisis, this is one quote which came to me. It was by Benjamin Franklin. By failing to prepare, you are preparing to fail. So basically, You really need to plan ahead about what is going to happen, and you need to have your contingencies on point. If you just sit now and if you think that everything is wrong, everything is bad, everything will be bad after the crisis gets over for you, because you do not have a plan of action and you do not know what will you do if your employment is not there, if your business is not there. So you have to, in the current scenario, you have to sit at home, stay safe, stay healthy. However, please plan ahead, look at what you're going to do ahead in your life if your things do not work out right now, and have it as tangible outputs rather than subjective estimates. Thank you.